Good afternoon, everybody. Rich Sykes here, the traveling tax guy on the Wise or Otherwise. I am going through the last week of extension deadlines, and I will just say that a lot of people just do not realize what in their life could affect their taxes, and they go about it blindly. So I just decided I wanted to do a video on 15 things that maybe you don't realize will and can affect your taxes. So here we go. Number one is having a child. Obviously, if you are married and you have a spouse and y'all have a child, there are credits that are available for that. Child tax credits, additional child tax credits. You could have child and dependency care credits. All sorts of things that could affect your taxes. So make sure if you do have a child, you consult an advisor. Getting married. If you are single, you have a standard deduction, or if you itemize, you have less of a standard deduction to overcome to make your itemization worth it. If you're married, it's basically double. It's $25,900 for 22. It's going to go up from that for a married filing joint couple. If you are married, you probably should always file jointly. There's only two ways you can: married filing joint and married filing separate. You can't say one of them, well, I'll do head of household and take one child, and I'll do head of household and take the other child. If you are legally married, you can only file one of two ways, and that's married filing joint, married filing separate. And that can affect your taxes. Your tax rates are typically higher for more income. So again, consult a qualified advisor to help you out there. Now, on the other end, if you get divorced or separated, there are rules for separation and not being divorced. It depends on how long you've lived with the person that tax year. You could, in fact, if you have a child, a qualifying child, even though you're legally married, there are situations if you have a separation agreement and you haven't lived with this person for the last 6 months of the year in the same household, then you might be able to claim head of household there. But if you are divorcing, you typically are going to file, if you can come together, you can still do married filing joint if you're still married. Or if you do not decide not to and you don't qualify either one for the head of household ruling, you have to file married filing separate. There are some credits you're not going to be eligible for. There are going to be some different tax rates for married filing separately. So even though you might be going through a divorce, it might be helpful to get together and say, well, let's go ahead and file jointly and save both of us some taxes. How about getting a new job? Now, this, I think I talked about filing a W-4. If you get a new job in the middle of the year, that job doesn't know other than what you're getting paid every pay period times the number of pay periods left in the year on how much to take out. But you might have already made $100,000 or $50,000 or whatever you make prior to this job. You need to justify how much you're being taken out, or literally you might not have enough taken out because that'll be additional income. Your other job has stopped taking money out probably, unless you have 2 or 3 jobs. But regardless, getting a new job could affect your taxes, and you need to consult somebody and find out how. Losing your job. If you lose your job, you might go on unemployment in whatever state you are. Unemployment is a taxable income. So you need to make sure that you're having taxes taken out for that unemployment compensation that you get from the state. If you lose your job and you're not working anywhere, obviously you might have been taking out quite a bit of money from the prior job, and now you won't have that type of income anymore. So it could affect your taxes, and you could be eligible for a larger refund. But losing your job can, in fact, obviously affect your taxable income. How about retiring? Now, you work at a place and you're getting a good income. Well, you probably won't be getting that type of income once you retire. So you need to kind of not only plan for retirement before retirement, but plan on how much you're going to get as you retire. If you get Social Security, if you get a pension, if you're taking out of a 401k or an IRA or a Roth, you need to know all of these things, because all of that can increase your taxes. Typically, if you're getting Social Security in, that is not something that most people have taxes withheld from. And on its own, Social Security is not taxable. But if you add other income to it, like a retirement plan, a pension, or any other types of income, you can make your Social Security taxable. And there are thresholds you need to be aware of, and you should contact someone that can help you out to find out if I'm retiring, I'm taking Social Security, I'm also getting a pension, I'm also taking something from my 401k, or I'm not doing anything, and see what your taxes would be with that. You'd be surprised. Now, a Roth, we'll get into that in another discussion, but a Roth is something you've planned for. You've invested money into that. You paid the tax when you invested the money, or you put the money in. So any money that you bring out of a Roth is non-taxable. If that is your major source of retirement income and you get Social Security, the Roth is not considered taxable income, so it would not increase your Social Security income. So know these things. Talk to a professional. Maybe long before you think about retiring, you should be sitting down with someone to kind of plan out these things for you for retirement. How about buying a new home? Now, if you are a first-time home buyer, you might have been paying rent all along, and you cannot, if you itemize, deduct rentals prices for your Schedule A or itemization expenditures. So if you buy a home, there's a couple of ways that you can deduct some of those costs. So you have a cost, and most people have a mortgage. So if you had a $200,000 home and you took out a mortgage, the mortgage interest that you pay is deductible. And also, now I will let you know, it's changed just a few years ago. If you get a HELOC, which is a home equity line of credit, that interest is not deductible any longer. So if you had a home and you bought it and now you've refinanced that loan and you're taking money out, what is deductible is acquisition debt interest only. So the money you took out as a loan to purchase the home, initially purchased the home. Now, if you've a couple of years later gone and refinanced your house and took money out, you're going to have to decide, based on the new interest rate and the new amount, how much of that payment and how much of that interest is actually for acquisition debt. The IRS is really cracking down on that, so you need to pay attention. The interest that you can deduct on a Schedule A or itemized deduction is only for acquisition debt. The second thing you can do in buying a house, you're going to pay property taxes on that house. So real estate taxes or property taxes are deductible on a Schedule A. Now, the alternative to Schedule A, which is itemized deductions, are your standard deductions. They are quite considerable now. I think it's $12,900, or if I'm not mistaken, for a single person. It's about a little over 19,000 for a head of household. It's half, the 25,900 for a married couple. It's half of that for a married filing separately couple. So make sure you know what your standard deduction is. And this is the little tip I will say. A standard deduction is something the government gives you, right? So what makes up your itemized deductions are medical costs that are 7.5% above your adjusted gross income. I'm talking in the weeds, so you might say, well, I don't understand that. Well, Exactly. You have charitable contributions. You have only acquisition debt interest. You have real estate taxes and state taxes. So there's actually state and local taxes, and real estate taxes are part of those. So you need to know that you're capped at $10,000. So if you live in a high tax income tax state and you pay high property taxes, you're capped at $10,000 that you cannot take. And all I'm trying to say is make sure it's worth it. Okay, make sure that you're getting the benefit. Now, with the period of really high mortgage interest, that mortgage interest could be higher than it was back when it was 2%. And for a lot of people, itemization wasn't worth it. But now, with high, 8% mortgage rates, I mean, people are paying quite a considerable amount, plus the high cost of the houses. Your mortgage interest is not restricted, other than it's got to be the acquisition debt only. So pay attention to that. Starting a business. If you start a business, the IRS typically will allow you to have 2 out of 5 years of losses. Now, if you're operating your business like a business, they are a little bit more lenient on that. In fact, Amazon, which we're all familiar with, actually lost money for the first 17 years. And you say, well, Rich, how did they do that? Well, they were obviously operating a business. They had worldwide knowledge and locations. So the IRS understood they were trying to build out a logistical distribution center in every corner practically. And that takes a lot of money. And they were investing, and it wasn't like they were fly-by-nighters. They were actually operating a business. So they lost money hand over fist for the first 15, 17 years. And you might have heard that they're not paying taxes now. Well, what you do, if you're losing money and you are eligible to continue that loss, you can roll over a loss for like 19 years. And so 17 years ago, when they lost money, they just, whatever taxes, the amount they lost, they added it to the taxes that they owed this year, or the years they started making money. And they were able to get away with not paying taxes for a few years. But starting your own business. Now, it's very simple in the sense of an IRS business. A Schedule C on your 1040 is for a sole proprietorship. Now, if it's husband and wife, you need to talk about this and say, well, I'll be the business owner and you won't be, because if you actually have two owners, that is a partnership. Now, all of a sudden, you have to file a different tax return. It's a 1065. And so if you go and don't know what you're doing and you need to get someone to help you, I mean, in a lot of places, a 1065 tax return by itself is going to cost you $500 to about $1,200, depending on how complex it is. So if you want to save yourself some money on taxes, start out small. You might be doing investigations, but you might be incurring expenses. If you have some startup expenses or incurring expenses, you can do one or two things. The IRS will allow you to, if you're generating any kind of income, to go ahead and expense those, or you can kind of save them up. And now they're called startup expenses, and that when you do finally start generating income, you can start amortizing that startup expenditure. So just understand that starting a business can get you a difference on your tax return. A lot of people might have a side gig, right? And they're getting active income through a 1099. So a 1099 NEC is a tax return or a tax form that you'll get instead of a W-2. So at the end of the year, a W-2 is for employees, and you'll have your taxes withheld right then and there, hopefully enough. But a 1099 will not have any taxes withheld normally. You can ask your people that are paying you by 1099, but most people don't, right? And from that 1099, unlike a W-2, as an employee, you're very, very, very limited now on taking out any expenses that it costs you to do your job. So it used to be that your boss might say, hey, why don't you drive your car? Why don't you use your laptop, or why don't you use your cell phone to make calls? Those kinds of things. And you could itemize on Schedule A employee business expenses. Well, they did away with that in 2017. And so now you aren't really given any benefit of utilizing your own assets for your boss's job. So you can, if they have what they call an accountable plan, and you can ask your company, hey, do y'all have an accountable plan? Because I'm still using my car, right? Now, they can reimburse you for those uses, and you will not have any cost whatsoever. They won't even include that on your 1099 or on your W-2. That is an expense reimbursement, basically. But on a 1099, you started a business and you're generating income. If you generate more than $600 from one individual and you are not an incorporated entity, they're required to send you a 1099. So you might get 5 or 6 or 20 or 150 or whatever. And now you're going to have to enter all that in. That is considered active income. Not only are you being charged income tax on active income that you get 1099, but any profit will also generate self-employment income. So can a business actually affect your taxes? Oh my God, yes. And you need to make sure you consult with someone that is knowledgeable on new businesses. But on the same token, if you have a loss that year, that actually reduces other active income, other income altogether. So, if you have a loss the first year, you might look at the loss of your business is not a bad thing. It's actually helping reduce other taxes. So just know that. Inheriting money. Now, what you need to understand is if you inherit money, that money, if it is literally just money, is not taxable to you. A gift is basically like a gift. Somebody can gift you right now. If you've got someone that just loves you to death and they gift you $100,000, believe it or not, that's not taxable to you. If you did no service for it whatsoever, that is not taxable income for you. But if you did service, then yes, that is taxable. Now, the person giving you the gift is limited to giving any individual $17,000 without generating a gift tax return on their part. So you're fine, right? You're not going to get taxed on inheritance. Your parents pass away, your aunt passes away, and you get money, no problem. The problem is if it is a retirement type of account. So if they have left you an IRA, a 401k, those kinds of things, there are rules like you really don't need to ignore. You're typically required within a 10-year period to take everything out. Okay, so you might be in the middle of your work world. You're 35, 40 years old, and all of a sudden you get a $500,000 IRA retirement, inheritance. You've got 10 years to take $50,000 a year out, and any additional income it derives from that. $50,000 might be something that is going to cause your taxes to go up. So be aware of that. Make sure you understand if you receive an inheritance, if it is typically property or money or life insurance or anything like that, it's not taxable. You just enjoy it, right? It's tax-free. The IRS said, oh, wow, give you something for free. But if it has to do with a retirement account of any kind, there are rules and regulations, and you will be required to. Now, you can donate it to somebody if you want to, but you will be required to pay tax on that money. So just be aware of that. So getting an inheritance of some sorts could be taxable. Winning the lottery. Okay, I've had situations, and so this is something that you fully need to understand. If you go and win, even let's say $1 million lottery is a scratch off and you won $1 million, and they will usually take out about 24%, right? Well, unless you give that money away to charity or something, they're going, if you receive $1 million, that's your income for that year. That 1 year, you're going to have $1 million. The tax on $1 million is not 24%. You're going to be in the very highest tax bracket, which is going to be, 36 is the highest, but then there are what they call the investment and excise taxes. And so they might tax, depending on your situation, they could tax another 3.8% onto that. So you would be like at 39%. Well, if you've only taken out 24%, when they give you the money, they're going to take some of it. You're not going to get a check for $1 million. They're going to take some out and put it away. But I've seen people sit there and say, well, I thought I paid my taxes. No, you need to get in touch with somebody that is aware of tax rules and rates, so that you can make sure that you set aside some money. Don't go spend it all. Most people that win the lottery do, and they're bankrupt in a couple of years. Make sure the first thing you do is you put enough away for taxes, and then once you do that, and don't touch it, you can go ahead and send it in as a estimated tax payment to the IRS, believe it or not, and make sure your taxes are taken care of. Again, you give it to your mom, that's nice, but that's not a tax deduction. You give it to your aunt, that's wonderful of you, but it's not a tax deduction. So the money you have, unless you give it to a verifiable 501c3 charity, there's no tax deduction for that. Well, I was taking care of my sick mom. Well, that's you're a good son or daughter, but that's not a tax deduction. Now, there are elderly and disabled tax credits you might be able to get, but you have to prove that that's what it is. It's not like I'm 35 years old, and my mom is 55 years old, and I won the lottery and I'm giving it. She just decided to quit work. You're going to have a hard time convincing the IRS that she was, one, elderly or disabled. So just be aware of that. Winning the lottery can be a good thing, but it can also be terrible. And especially if you spent a lot of the money, they don't care. Sell what you bought and pay those taxes, right? Receiving unemployment benefits. We talked about losing a job, how that could affect. Unemployment benefits are taxable. You have to tell them, now it's typically a lot lower than you would be earning, but let's say you didn't work for 26 weeks of the year and you got unemployment. If you had nothing taken out, there's a good chance you're going to have taxes owed on that. So make sure you understand unemployment benefits are taxable, and possibly, depending on what you made in the past before you lost your job, you might want to adjust it so that you can have the correct amount of taxes being withheld. Again, a professional should be able to help you do that. Cashing in investments. Okay, so investments are typically a passive activity, right? But if you've held that investment for longer than a year, not 1 year or less, it's called a long-term capital gain. And if you do that and you sell it, you get a preferred tax rate. And so depending on your filing status, some of it's going to be a 0 tax rate. Some of it's going to be a 15% tax rate. And if you're really making a lot on your investments and other income, you could be taxed as high as 20% on that. So understand also the timing, because I mentioned a longer than 1 year is long term. 1 year and less is considered short term. Short term does not get a special tax rate. It is taxed at ordinary income, and you need to be aware of that. So you're doing day trades, right? And you're making a lot of money on this, or you buy something and you flip it, the house, and you make a lot of money. That is still considered 1 day to 365 days as short term. You pay ordinary income rates on that. So if you've made money other places and you're in the 32% tax bracket, those gains will be considered 32% taxed. If you're in the highest tax bracket, again 36, that's where that short-term capital gain is ordinary income tax rates. So just be aware of that, all right? Donating to charity. Now, there are limitations on what you can donate and how much money of your income you can donate and deduct it. Now, you can give everything to charity if you want. It's just not going to be tax deductible. There's difference between that tax deductibility and legality. All right. You could give, if you won a lottery for $1 million and you gave it to charity, doesn't mean all of it's going to be tax deductible. But you can do that. You can give the whole $1 million to a charity, and they would say thank you so very much. They'd send you a nice little letter and probably a letter stating that you're just the angel. IRS doesn't care about angels. I'll just say it that way. Moving to a new state. I am from the great free state of Florida, and we do not have an income tax here, right? So people that move to Florida that from a tax state, there's 42 states that have some sort of income tax. There's 8 that do not. I want to say it's Washington, Wyoming, Nevada, Florida, Texas. There's 2 more and I can't think of it. New Mexico, I believe. I don't know. But Florida does not. So if you move to Florida, you're going to avoid income tax. If you're from Florida and you move somewhere, Tennessee is one of them. Tennessee, yep. If you move to Tennessee, you still won't have an income tax rate. But if you move from Tennessee across the border to Georgia, you'll have income tax. And you need to understand what is taxable and what is not. But it can and does affect your taxes. So just know that. All right. And how about the last one here, number 15? Getting a raise or promotion. Now, there's been talk in the past, especially if you're an hourly wage person, right? That working overtime, that basically you're working just to pay your taxes, and that can be true. Now, if for some reason your salary was right at the top level of 22% tax bracket, or let's say it was at 12%. So your salary was right there where you were right at the 12%, and you got a raise that puts you into the next tax bracket. Well, your next tax bracket is 22%. So that's 10% tax increase. And what if it's only a 5% tax? A 5% raise? I mean, is it worth it? And you just need to understand that. But a raise can put you in a higher tax bracket, right? Now, it can also allow you to do other things. You can put more money away into you may be able to. I mean, you're still limited in a 401k of $21,000. But maybe you, at this lower wage, you didn't have enough money to put that kind of money away. So what you could do is if you now get a raise, you can just flip that money into a 401k and max it out. And we'll talk about how to even max it more to like 73,000, and then you're only still getting the $21,000 benefit, but then you just flip it over to what they call a backdoor Roth. IRS hates that, but I love it, right? So again, getting a raise can cost you. Just know your options. Talk to someone, say, well, my gosh, I got a $25,000 raise, and all it did was put me in a higher tax bracket. Okay, well, if you were living without $25,000 2 weeks ago, there's a good chance that you could take some of that $25,000 and put it into a retirement account for yourself, right? Or into some other, maybe you have other flex spending accounts that you can put into. We'll talk more about, health savings accounts and things of that nature that you could fund. And it's very interesting how the IRS, they allow things that they don't let out into the general public, and because they don't want people to do it. But, there's tons and tons and tons of ways to basically hide your money. And legally, they know it. I mean, they're not saying, oh, you can't do that. No, they wrote it so that you can do it. It's just that most people don't do it. So again, this is wise or otherwise. So we want you to be wise with your money. and we'll show you how here on this channel. My name is Rich. I am traveling around the country because why? Because I can. I used to be all nice and clean cut and wore a suit to work, and COVID hit, and guess what? Nobody wanted to come see Rich in the office anymore because they were scared to get COVID, even in Florida. So they said, well, can we talk on the phone or can we do Zoom calls? Yes, we can, but I can do that from anywhere. And so I took the opportunity to travel the country, see things that I've never seen, and I'm enjoying life, and I'm hopefully educating you. So that's 15 things that are going to happen as everyday life happenings from a lot of people in this country and how it can affect you. So review them. If you have any questions, just comment down below, and I'll see if I can't get your questions answered. But again, 15 things, common everyday things that can affect your taxes. All right? Remember, be wise, or otherwise